Hello, this is Joe Pryor, the virtual real estate team in Oklahoma, where we specialize in new residential construction for investors in the Oklahoma City and Tulsa markets. The good news as we're in 2026 is that interest rates have gotten a little bit better. Not great, but they are moving in the right direction. But again, in previous videos, I have talked about where builders who are big builders can put up millions of dollars up front in order to buy the interest rate down before you get it. Now, we're going to talk about Fannie Mae loans for investors right now, and we're going to talk about the closing cost allowance and what it does if you use it for an interest rate buy down. So, what a par rate is, for those of you that have not done this before, is where there's no points. In other words, it is you don't have to put out any money whatsoever to get that rate. So, we have one builder, for instance, that's buying it down before you even see it to 5.375% fixed rate with 25% down. Now, you're getting a 2% closing cost allowance, which is what Fannie Mae limits you to, is 2%. Now, that is based on the mortgage balance. So a $250,000 purchase, for instance, is going to be $187,500 in terms of your mortgage amount. So the 2% is on the $250,000, but you use it for the buying down the interest rate. So if you use the 2% with this particular builder, then we're basically dealing with 4.75% fixed rate. Now, the question I know that is on your minds now is, well, why should I use this for an interest rate buy down? I've got closing costs, and yes, you do. But here's the thing. Just doing what I just said will get you $71 per month extra cash flow. Now, in some markets, that may be the difference between negative and positive cash flow. In Oklahoma City or Tulsa, it means a whole lot more. So we're already at positive cash flow. Now we've increased it. But here's where I typically look to see if it's worth doing. In other words, if I'm taking that 2%, how long does it take for me to get that money back? In other words, $71 a month. So basically what we're talking about is about a little over 4 years. And what that means is you've got 26 more years of a 4.75% interest rate. Now, I've got investors that bought from me, say, for instance, in 2004, and they still own their properties. But let's say you only want to keep it 15 years, not 21 years, and keep holding it. Well, if you hold it 15 years, that $71 means that you've made an extra $9,372 on your investment. So that adds in that plus the extra cash flow that you're getting, plus the appreciation. The numbers work out extremely well for you. So when we get together and we talk about a plan for you and what you're going to buy, I'm going to describe these differences for you so you can see if it's worth it to you to go ahead and buy down the interest rate. But if it took 10 years, I wouldn't be recommending it. 3 or 4 years, I definitely recommend it. We'll talk about it and see if it's an advantage to you. But that is the basic idea behind using your 2% closing cost allowance to get down to a lower interest rate that's fixed for 30 years.